But this is our question, and Alex alluded to it. Tech is wrecked. Certainly the stay-at-home element of it is, but take a look at even Microsoft, names like that, being absolutely battered so far this year. Now, bonds were leading equities, but it now looks as if equities are leading bonds. We are seeing a bid back in the bond market, a bond starting to play their traditional counterweight role. I think a lot of people are trying to figure that one out at the moment. Clearly, we are in the pre-Fed phase. Romaine, Bostic, joining us now to kick that around, Bloomberg Markets and the Close co-host, Kristine Aquino, who leads Bloomberg EMEA Markets coverage here in Europe, a rates and FX specialist. Kristine, I'm going to start with you. Last week, it was rates leading the equity market. Now it's equities back in charge. Is this bid in the bond markets just a derivative of what is happening in equity markets? Is it starting to play that kind of safe haven role once again?
Well, yeah, I think today it is. That's definitely what we're seeing, because all of those havens, the treasuries that were selling off massively at the start of this week, are the ones that are really getting bought big in today's tech sell-off. And I think it really is what we're seeing, that catalyst from the bad news from earnings from Netflix and Peloton really kicking off this risk aversion. And that's why we started the week worrying about the great big bond sell-off. We're ending the week worrying about the great big tech sell-off.
Romaine, I don't envy your job. I used to anchor the close also, and like when you have a day like this, you know it's going to be ugly.
Yeah.
What do you kind of prep for? Do you think we're seeing the sort of tech wreck go buy bonds? Is that it?
I think so. And I mean, you're seeing the softness. You saw basically what happened on Wednesday, what happened on Thursday, where you saw pretty strong bids come in earlier in the day, and then that completely faded later in the day once you got to the close. The idea here that the level of conviction out there just really isn't there. And a lot of folks are concerned right now about the fundamentals, how it's being eroded, whether it's by inflation, whether it's about what the Fed is going to do, or really just about some of the broader economic issues. And what Kristine alluded to so far is we're still early in the earnings season, but it's been a bit of a disappointment. We're just not really seeing a strong growth. We're not really seeing strong guidance. And now the concern is that as we start to get those big cap tech stocks next week, Apple, the Microsofts, the Teslas of the world, we could hear more bad news from the heaviest, weightest members out there.
Absolutely, and this is a market that's got narrower and narrower around those kinds of stocks. Romaine, do you think, though, we are going to find ourselves in a situation where, particularly for those tech names, particularly for those big tech names, as we start to see maybe yields coming back down again, that limits the damage that ends up getting done in the tech space?
I think a big game changer potentially for this market could be on Wednesday when we do actually hear from the Fed, and we're going to get, at least according to our Bloomberg economics correspondent, Michael McKee, a roadmap here as to what the Fed is going to do with regards to not only raising rates, but drawing down the balance sheet. And I think the certainty, assuming that we get it, that certainty could actually maybe provide a little bit more optimism for this market. But right now, the market is really trying to figure out not only what the Fed is going to do, but how aggressive they're going to be and how that affects valuations. That's why you're seeing so many swings in equities. I think it's why you're starting to see a little bit more defensiveness with regards to people buying bonds and, of course, a flight to some of the haven currencies out there like the Swiss franc and the yen today.
Can I just go the other side here, Kristine? How much of this is also potentially foreign investors coming into the bond market and buying because we've had a deep sell-off and now bonds are a little cheaper?
There's absolutely an element of that for sure, Alex. I mean, we've heard time and time again, all of these investors, particularly pension funds, really clamoring for those higher yields that they just haven't been able to get from bonds for such a long time. And so we finally got a taste of that. We're definitely seeing some signs of pensions potentially de-risking right around this time, just because we've had such a big run-up, and perhaps it's time to go back a little bit to the classic haven trades here and buy up a little bit of those bonds.
Just in terms of what the expectation is for next week, where are we in terms of pricing? We've moved beyond 25 basis points for March. There's now a growing expectation, and I heard it today from Bank of America's Ian Harnett, that we could maybe put 50 basis points on the table. Just to this move lower in yields today, how quickly could that get interrupted?
Well, Guy, we've definitely seen today's moves take a little bit of shine off of those March expectations for sure. I think last time I looked anyway, before I came here, it was about 25 basis points, just about fully priced for the Fed in March. But you're absolutely right. You know, we should definitely be looking at that and seeing if there are any signs for additional rate hikes, because this idea of 25 versus 50 definitely gaining traction this week. That was part of why we saw bonds sell off massively at the start of the week. And so if we get get a resumption of that next week, then it's definitely going to enter the conversation once again.
Yeah, you're right. It's about 26 basis points. So we're just at that one hike level. Romaine, I mentioned it earlier, when we don't know what happens in a market, we tend to blame options. And that's what Goldman Sachs is talking about, that there's like $3 trillion worth of derivatives expiring. How much credence do you put into those kind of headlines?
Well, a lot of credence. I mean, this is a major options expiry here in the U.S. today, here, and that's having I have a lot of reverberations with regards to volatility. But then it comes back to valuations here. I think Guy was talking about this idea is like, do you want to be exposed to this over the weekend, particularly heading into what's going to be a busy week for earnings, a busy week for Fed policy, Fed communication here, or do you just wait that out and wait and see? Think about how much money has gone back into cash and cash-like instruments. Now, a lot of strategists we talk to, including over at JP Morgan and Bank of America, say a lot of that money is itching to get back into the market. The question is, what's the entry point? Where's the opening?
In terms of how big a shift we have seen this week, Romaine, just give us your sense. We haven't seen a proper correction, and there's a huge amount of debate around what constitutes a correction. Like, people arbitrarily talk about 10%. But in terms of how that has affected market psychology, how much damage has been done this week?
I think it's affected it dramatically. I mean, we went more than a year without any sort of meaningful correction, at least based on that 10% barometer. You have the Russell 2000, which has basically been in correction now since early December. You have the two NASDAQ indices now down 10%, the S&P down more than 5%, and now, of course, you're looking over there where you are in Europe, and you're looking at a stock 600 down 4.7 or something percent before I came on air from its all-time high. I mean, these are meaningful drawdowns, and more importantly, Guy, it's the idea that we haven't seen these types of drawdowns in quite some time, and that rattles folks.